Hi guys, welcome back to Father and Son Investing. If you watched the Treasury bill video that I did prior to this video, you'll see that I actually welcomed myself back to Father and Son Investing as well, since I've been absent pretty much for the last 4, 5, 6 months or so. Today's video is going to concentrate on Treasury notes and bonds. We're going to talk about what the current state of Treasury notes and bonds looks like. We'll talk about some factors that will affect your decisions as to what type of Treasury note or bond you might be interested in buying. And then we'll talk about some potential wildcards here in your decision making. So let's get started. Let's just take a quick look at where we're at when it comes to notes and bonds. Of course, that means starting at the 2-year Treasury note and running all the way up to the 30-year bond. The one thing that the Wall Street Journal doesn't show here is the 20-year bond. It's kind of interesting that they don't show that, but the 20-year bond is actually giving a little bit higher yield even than the 30-year bond. But you can see what things have looked like over the past year with each of these. All of them were up, took a big turn down, and since September when the Fed decided to cut rates, all of them have taken a turn towards higher yields, meaning lower prices. So there we are, all of them, including the 2-year note, which hasn't made its way back to where it was in May of 24 yet, but all the others you can see are doing quite nicely when it comes to yields. Here's another way of looking at these graphically. We're interested in the 2-year out to the 30-year, and we can see that all of these, the blue is slightly higher than the red, meaning that yields have gone up since the end of 2024. The other thing we can see here is that the yield curve has uninverted, meaning that the 2-year yield is now less than the 10-year yield. That's what should be happening in a normal bond market. However, we can see that the term premium, or the amount of extra you might expect for investing in this longer dated maturity, the 10-year note, really isn't that much more. It's only about 300 basis points. We'll talk about that more later. Now that we've shown where we're currently at, let's talk about the immediate near future here. This is the quarterly refunding statement from October 30, 2024. In here it shows what the Treasury expects to borrow each month. Now, we will be getting another quarterly refunding statement at the end of this month that will project us out for February, March, and April, but let's just look at what we expect to borrow in the U.S. for the month of January, which is not quite over yet. You can see that these are all in billions of dollars. Each of those denominations you can go ahead and take a peek at. You'll notice that they're pretty much the same as they have been over the last few months. Still, that is a lot of money. In fact, if you run up to the top of this quarterly refunding statement, you will get an idea of just how big some of these Treasury offerings are and how little new money they're actually bringing in. So for instance, Treasury offering $125 billion. It would bring in $116 billion to repay all of the Treasury notes and bonds that were maturing, and the new money that would come in was only going to be $8.6 billion. This is what our Treasury auctions look like now. It's really pathetic that most of the auction goes to pay back previous debt. Now let's go ahead and talk about some factors that may affect your decision in terms of whether you're buying any Treasury notes or bonds right now. Here's the first one I want to touch on. This is a little bit of a busy slide here, but it gives us a lot of information here. So this is from the recent 10-year Treasury auction that took place here in January of 2025. And let's just talk about all of these graphs here and the different colors. So the first one that we can see here that I'm going to talk about in black is called the bid to cover. I've talked about that in previous videos, but essentially just know that this is the amount of money that was bid versus the amount of money that was auctioned off. So what we can see here in this black line is about 2.5 times the amount of money that was offered up to buy Treasuries versus how much was actually sold. So when this bid to cover number is high, for instance, way back here, it was much higher, it was 3.5. That means there's a lot of interest in buying U.S. debt. So 2.5 is okay, but what we will notice is that it's down from the previous month. The next thing I want to cover is direct bidders. That's this part here in red. You could include U.S. households in this. You could also include things like banks and insurance companies, etc. These are U.S.-based entities or people who are buying U.S. Treasuries. So you can see this part here in red. Now this part here in blue goes to primary dealers. There are about 20 of these in the US, and they are required to bid on an auction, and they are also required to take up whatever doesn't get purchased at auction. So we can see in the past that the primary dealers used to take a lot of the auction, but the trend has been downward. We'll notice that this blue line here at the end actually went up from the month before, meaning the primary dealers had to take a little more this time than they did previously. This part here in green that is taking up the biggest amount, it says indirect bidders, but you can think of this as foreign entities buying U.S. government debt. And therefore, this green line is a little bit less long than it was, meaning the foreign entities took up less of the debt this time, and primary dealers had to go ahead and suck up some of that. And then here in yellow is the high yield. You could just essentially look at this as the yield here, and we'll notice that the yield has been going up as we demonstrated on the previous graphs. So what's the take-home point from this busy slide here? Fewer dollars being sucked up, or fewer treasuries being taken up by foreign bidders, and more treasuries being taken up by primary dealers. And that's not just this month. We can see, if you're looking at this sort of blue squiggle here, that the trend is sort of upward. If we were to be going along a trend line, it'll be curious to keep an eye on this to see what happens. This tells us essentially how a Treasury auction went. There's actually one more thing called a tail, and I'll tell you that for this particular auction there was a tail, meaning the government had to give just a little bit extra yield to get people to buy their 10-year Treasury note. So that covered factor number one, the demand. Now let's talk about that term premium that I mentioned earlier. Here's an article in MarketWatch. The headline says, "The bond market is fussing over the term premium. This is why." If you're not familiar with that phrase, term premium, let's just go ahead and talk about that. That reflects the risk involved in locking up your money for a decade rather than just repeatedly reinvesting your cash into something short-term such as 1-month Treasury bills. This is that extra compensation that makes sense because there's more of a chance for interest rates or other important variables to change over a longer period of time. If the government wants your money for 10 years, they need to pay you a little extra compensation. Now, the New York Fed actually tracks what that term premium is according to their models, and they show that the 10-year term premium has risen 85 basis points since the Fed changed their rate. Remember that big 50 basis point rate decrease that they did back on September 18th of 2024. Now, they also go on to say that the rise in term premium coincides with the almost 112 basis point increase in the 10-year over the same time. So they're saying here that essentially most of that rise in the 10-year yield has been term premium. Now, you may be asking yourself, what would be a reasonable term premium? Is 85 basis points enough? Well, we're going to borrow this from wolfstreet.com here, and he goes on to say that a spread of 100 to 200 basis points is kind of a normal range. So we're below that right now at 85 basis points of term premium. But if we were to just say 100 basis points, then that would give us some idea here of what things should look like. If the 2-year yield is at 4.4%, then a 10-year yield should not be at 4.77%. It should be at 5.4% with a kind of normal term premium. If that term premium went up to 200 basis points, well, then you would be looking at 6.4% yield on the 10-year note. So that is what you could look at as a normal situation. So we're not quite to normal yet when it comes to term premium. So we now have discussed some demand issues. What is the demand for U.S. Treasuries? And we've talked about term premium as some factors that might affect your decision. Let's talk about another factor, the bond vigilantes. I actually made a video about this that I'll leave a link to that discusses bond vigilantes more. Just who or what are the bond vigilantes, and are they back? Well, look at this as people who do not like the fiscal course of the United States, or really of any government. This affected the British government, as I explained in that video a few years ago, and has in the past affected the U.S. government. These are entities which decide that the fiscal policies of the United States are not in their liking, and therefore they go ahead and start selling off their treasuries, or they refuse to buy treasuries, or both. Here's a little bit of what I'm talking about. This is from the folks over at pimco.com. Vigilance before vigilantism. By some measures, investors have already demanded higher yields to lend to the bond market. At the same time, we have become more hesitant to lend longer term given U.S. debt sustainability questions and potential inflation catalysts. And when it comes to what the folks at PIMCO are targeting, you can see here that they're saying targeting short and intermediate dated bonds. This is becoming a little bit of a theme, and you could think of this as bond vigilantes. If you want to know more about the bond vigilantes, just watch that previous video that I did. Now let's go ahead and wrap up this discussion by talking about two potential wildcards here. The first wildcard is going to start on January 20th. That's when the next presidential inauguration will be in the United States, when President Donald Trump takes over. Now, we've all heard of some of his economic policies or other policies that could affect inflation. But I want to talk about something that happened during President Trump's last term that has kind of gone a little bit by the wayside. You may recall that when the Fed started raising rates during his last term, that he got highly upset about that and started putting pressure, or at least trying to apply pressure on the Fed to lower rates again. I think that's going to happen during this term as well. He thinks that interest rates are way too high right now, and he's going to be putting pressure, talking about it a lot, in my opinion, talking about this a lot, trying to get the Fed to lower rates. Now, what happens when the Fed lowers rates? Well, that's going to decrease short-term borrowing costs and potentially start increasing the U.S. economy. And when that economy heats up, guess what happens to inflation? And as inflation goes up, guess what's going to happen to these bonds, particularly out at the long end? In fact, it's may already be priced in a bit there, so it might not go up as high as we might anticipate, but that's, I think, part of what is keeping the long end of the bond market so high right now is the anticipation for inflation. And if that happens, will it drive it up even more? So that's one part of the wild card. Here's another part of the wild card that I personally think with President Trump and isn't really being discussed much. And that is, I think he's going to be saying that long-term borrowing rates are way too high as well. Now, the Fed doesn't have a lot of tools in their tool chest when it comes to long-term rates, except for one very big tool, and that is quantitative easing. Right now, they're in a process of quantitative tightening. If you're not familiar with these two terms, quantitative tightening and quantitative easing, let's just talk about that. Quantitative tightening is when the Fed is taking things off of its balance sheet, which it has been doing a lot. This is an example of quantitative tightening. Here is the Fed's Treasury securities on their balance sheet. We can see that here during the pandemic time that just the Treasuries got up to about $5.7 trillion that they were holding, and since then they have managed to take off about $1.2 trillion. Now, the other thing also that they're running off of their balance sheet, though, are mortgage-backed securities. Mortgage-backed securities will affect what your mortgage rates are, and you can see that the Fed has been running those off of their balance sheet as well. Now, quantitative easing would be the opposite. That would be this end of the curve where the Fed starts running these things up onto their balance sheet. As the Fed buys up all of these securities, banks now have more money to go ahead and lend, which will bring down interest rates. So I think there's going to be some pressure potentially from President Trump to try to get the Fed to start increasing their balance sheet as well. What happens with both of those? Well, if there's more money out there to lend, more money running around, you could expect increased inflation potentially. If that inflation gets too high, well, then what happens? The Fed starts running things off of its balance sheet again and potentially raising rates as well as it did during that last bout of massive inflation in the United States. So this is a wild card here. We'll have to wait and see what happens with this new presidential administration and just what sort of pressure they want to try to apply to the Fed, which is supposed to be independent, but we all know how politics can work. Second wild card I want to talk about, and that has to do with what's happening in Japan right now. Now, the reason that I bring up Japan is that they hold about $1.1 trillion worth of U.S. Treasuries, and they are having inflation right now. And Wages are increasing in Japan, and the Bank of Japan is expected to hike their rates. Right now, they're at 0.25%. You may remember that Japan actually had negative rates up until about March or April of last year, and now they're expected to raise their rate to 0.5%. So what happens if Japan starts raising rates? In fact, I've seen some concern that their bond rate, which would potentially increase as the Bank of Japan raises their interest rate, their bond rate potentially could start to approach 2%. And what happens there? Now, I won't touch on this too much because it's a little bit speculative, but just to understand how, really what I'm introducing here is understand how the bond market is really a global thing, not just here in the US. If the Bank of Japan is raising their rates, and you are Japanese and are holding U.S. securities, things in U.S. dollars, and your yen is getting stronger against the dollar, well, the value of those U.S. securities are going down when it comes to yen. If you purchased a bond for 160 yen, and as the value of your yen starts increasing against the dollar, well, now your US dollar is only going to potentially be worth, say, 150 yen. You're losing money. And therefore, there could potentially be a sell-off there when it comes to Japan and the amount of US treasuries that they're holding. That likewise could happen in other countries. Now you can see here from this chart, here in yellow is Japan, and they've actually been decreasing the number of holdings that they have already. But if that were a bigger sell-off, that could potentially cause problems. It might not, though, because there are other places in the world that are increasing the amount of U.S. treasuries that they're holding. You'll see here that overall, all countries, things are going up. Really what's driving things up is what he calls here the top 6 financial centers. We're talking about places like London, Luxembourg, Switzerland, the Cayman Islands, Ireland, places where a lot of money is being held. And those places are driving up their purchases of U.S. treasuries. So this could offset potentially a bigger sell-off in another country. Still a wild card, something to keep in mind out there, just this global bond market and how that could affect U.S. treasuries. Now I want to go back to the folks at PIMCO here where they said that they're targeting short and intermediate dated bonds. They are not the only ones that I have seen during my study for this video who are talking about staying away from the longer end of the U.S. Treasury curve, the 10, 20, and 30 year. They're targeting 7 years and less. And that has to do with how much that yield curve may steepen. This is what I'm talking about when it comes to steepness. You'll notice that the longer end of the curve here gets steepest here between the 10 and 20. The thinking being that the 30-year potentially going up as well, going up more than the 2 to 7 year. And so if these rates down here, in fact, they talk about the 2-year rate being anchored, meaning essentially staying about the same, then your chance of losing money, should you need to sell your bond, is less because this part of the curve would be a little less steep should those yields change. So I actually go along with this same thinking here. What am I interested in the most? Well, it would be the 2 to 7 year part of the curve here, the 2 to 7 year notes. However, I personally am not buying until it hits 5%. I currently have a 2-year Treasury note that I got at a little more than 5%. When they last went up over 5%, that Treasury note's going to expire in October, and I personally am not touching them until I see 5%. 2 to 7 year, 5%. The 10-year note, I'm a little interested at 5%, but actually I'm a little leery of that long end of the curve, so I think I'm going to hold off and wait for something better than 5%. So that's my thinking when it comes to January 2025 notes and bonds. If you have other thoughts, go ahead and leave a comment. If you haven't hit that subscribe button yet, please go ahead and hit that subscribe button. And as always, until next time, enjoy your investing.